Hey, what's going on, cash flow hackers? It's Chris with Life 180, and today we are going to go through something fun. We're going to be talking about whole life insurance, utilizing whole life insurance in your life, and ultimately, this video is inspired by a client or somebody who is looking to potentially become a client, going through the process with my leadership team and going through the design phase, the planning phase, and ultimately trying to figure out how does this play into his life, into his family's life, into his goals and objectives and long-term views and the short-term needs and all the things that kind of come into play. I was shared the information by my team and asked to kind of take a look at it and see what I would say as a response to some of the feedback. Because I think what has happened here is that this individual came through, really loved the process, loved the idea and the concepts of what this is. And my guess is, I don't know this for sure, but my guess is that he talked to another financial advisor, somebody more on the traditional way of doing things, maybe somebody who believes in more of the buy term and invest the difference mindset. And so then what happens is they start getting into the math and all these things about all the different options. And so I want to take a minute, and what I'm going to do is I'm going to go through the email. I'm keeping obviously all the privacy, all the everything of this individual completely confidential. But I do think that this is an important message to be sharing, and I don't do many videos like this. But the reason I wanted to do this video is because I think this is probably something that a lot of people go through. This is probably a significant process that most people who are at this level are considering their options, and as well they should consider their options. And so I'm going to go through this email line by line, point by point, and do my best to talk about the numbers, talk about the technicals, talk about the philosophy behind why I believe so emphatically and what I believe in, and ultimately just kind of go from there. So that said, let's do this. I'm going to share my screen here, and we are going to jump right into this. So let me go here. And now what we got here is, so first of all, this gentleman was going back and forth with my teammate and with my partner, Tyler. And he was saying, thank you for the detailed email, because Tyler gave him a response. And he said, I just need to have this thing make sense from an opportunity cost perspective. Now, if you ever watch my content, you know that I believe opportunity cost is one of the most important things that we need to understand if we're really going to have success financially. And that is an important thing. And so I get and I love that he's thinking about it on those terms, that opportunity cost perspective. If you recall, the goal was to leave some legacy funds. So the goal is to leave legacy funds. So I'm going to write over here. So the goal, legacy. Okay. So I'm going to write that down to the kids and have another investment that gains interest without risk. So first of all, words matter. So this is not an investment. And the structural difference between an investment and a savings vehicle is to have something that gains interest without risk. That is not an investment. That is a savings plan, right? So it's not an investment. It's a savings vehicle. There's a wild difference. Investments you can lose money in always. And anything like this with whole life insurance, with a savings vehicle, maybe CDs or other things, you can not lose money based on obviously the guarantees of the bank and the FDIC and whatnot. But that's the idea here. So to have another, so I'm just going to assume that that was just kind of like wordplay, if you will, and just semantics. But I do want to throw that in there, that the savings concept, it's not an investment. You're utilizing this as a savings alternative, not an investment alternative. So he's looking for legacy funds for the kids for another savings vehicle that will gain interest without risk. Okay, so cool to know. So he's wanting to leave a legacy for his kids, and he doesn't want to take risk for it or with that money, right? So if I consider the same $2,000 per month investment, I can get 4.5% to 5% returns through a money market or CD without management fees, and it remains accessible. Let's talk about this philosophically. Okay, so money market, he's saying he can get those returns in a money market without fees. and he can get 4.5 to 5%. So I'm just going to pull this up and I'm going to just kind of write a little bit. So he's saying 4.5 to 5% right now in 2025. So here's the deal. My question to you is this. Why are we doing this policy? So anytime I talk to people, because this is, by the way, this is the most common thing that I get right now is why would I want to get 4 to 5% in a whole life policy at this moment in time when I can get 4.5 to 5% returns in a money market account or a CD without management fees? Why would I do that? Well, first of all, that 4.5 to 5% right now is in 2025. That has nothing to do with long term. If you were to go back to 2020, those numbers were like 2 to 2.5%. Okay. So it's a completely different world. The bottom line is we don't know where interest rates are going. They could go up, they could go down. I've done this a lot in videos. I'm going to do it again right now because I think it's an important thing to understand if this happens to be the first time that you've watched any of my content. But let's do this. So what we're looking at here is this is how things work. I think it's important to understand how whole life insurance works. So we have in 1980, interest rates were really high. And then we have 2009, and then we have 2025. Okay. So interest rates went down effectively to zero. Then we have funds rate goes up, dividend rates go up too. And then what happens is dividend rates will trail either down or up, but they have long term investments. And so that line is kind of where they go. So what happens is in 1979, the federal funds rate was at about 6 and it went way up. And then what happens is the dividend rates follow it, but then as rates start to go down on the whole life side or on the federal fund side, the dividend rates then have this crossover, or what I would call this inflection point, this crossover point where they went higher. And so then for that decade we had this arbitrage where it was chasing the federal funds lower. And because when the federal funds rate got low, whole life dividends stayed higher because they have this long-term perspective. So you're taking advantage of the long-term things. The cool thing about whole life insurance is you're going to get, from a long-term perspective, you're going to get bond-like returns, but you're going to get zero standard deviation effectively. You're going to have 0 down years. A lot of people think that you can't lose money in bonds, but you can lose money in bonds. If you go back to just after the COVID years, it was the first time in history that we had negative performance in the stock market and negative performance in bonds in the same year. So that negative impact that it has on retirement income planning and portfolios and so on and so forth, it's a big deal. So I wanted to show this because it's important to understand that we are now in this place where whole life insurance is in this inflection point where either dividend rates, whatever we're looking at right now, if interest rates continue to stay where they are, well, dividend rates are going to come up a little bit. And if federal funds rate continues to go up, well, dividend rates with whole life insurance will chase rates up just like they did in 1980. And that's just what they do. There's the interest rate environment is going to cycle. It's going to wave. It's going to go up and down like a roller coaster. And the thing with whole life insurance is all it does is flatten out the curve. So what's interesting to me right now, going back to this topic of this 4.5 to 5% kind of number right here, people say they can get that. And why would I do money in a whole life insurance? Is because you don't know what those numbers are going to be long term. Okay. So I think that's really important to understand. So now let's keep going. So he's saying if you can get 4.5 to 5% through a money market or CD without management fees, which, by the way, if you can do that, that's fantastic. But we're talking about long term, and I would say if you could do that long term with a CD, and interest rates don't go back down, which, by the way, right now with all the tariffs, with all the things that we're not able to like fully see in how the economy is going to go, I think it's showing a lot of shaky ground in the economy and what's happening economically. We don't know if we start to hit more of a deflationary area, they may have to drop rates again. And if they do, what's going to happen is these money market accounts, these CDs, these bond rates, everything is going to drop with it. And you know what won't drop that significantly or that drastically? Whole life insurance. And so when we're talking about all of this stuff, when we're talking about savings, what we're trying to do is get the most predictable asset that will solve our problems and also solve all of our long-term needs. And those long-term needs go beyond just wanting the cash, right? That's really important in my perspective. That's a really important thing. So let's go beyond that. Now, the CD through my credit union allows penalty-free withdrawals if something came up. I'd have to see the details on that, but they can do that. Plus, there's other ways to get low to no risk returns in the 5 to 7% range. And okay, that's fine. Bonds, he's saying, like bonds in the 5 to 7% range. Low risk, no risk. I don't know. I think if you go look at the bond returns and bond funds over the past couple of years, it's been shown that there's not necessarily no risk or even low risk in the bond rates. I think that whole idea of low risk in bond rates has to do with the fact that everybody has this period from 1980 to 2010, which is this 30 years where rates were just going down, right? And in that period of time, everybody just saw bonds as this low risk thing, and now bonds are lower risk than equities for sure. But how bonds perform when we're at these low rate environments, I would argue there's actually more risk in bonds, because either the downside is, or the upside for bonds is that we're at this 4.5 to 5% rate, and so if rates go down, well, sure, then bonds will perform to a certain extent, but there's still a cap on them. If, in fact, we have an inflationary issue and we have rates go down and then want to come back up, well, then those bonds are going to suffer again. And if we have inflation issues and the economy goes that direction and the federal funds rate has to go even higher, let's say 7-8%, well, then bonds are going to suffer for a longer period of time. And so I think the fact is, bonds have this idea of safety because of this long-term 30-year period, when reality is to expect the next 30 years to be like that 30-year period, and not more like what the last 15 years has been from 2009 to 2024. To me, that's more indicative of where we are. Maybe a little bit of a bump up from that, but if you just look at why and how bonds return, how they return, that's the deal. So that's an important thing to understand, right? And now the other thing that I would say is, like, let's get back to this now, is let's get into this. All right, so now he's saying, all right, if bonds are safe, well then, okay, that may be fine, but I really don't think they are safe, first of all. And then now what we're doing is we're looking at $2,000 per month is what he's looking at funding. $2,000 per month, and he's saying if I could get $2,000 per month and save that for 10 years at 5%, I'm looking at $310,000. For 20 years, we're looking at $822, and for 20 years, I don't know where he's coming up with that. I copied and pasted this, so I think it's a typo on their end. But 2,000 per month for 20 years. I think it might have been a typo. Maybe this is a longer period of time. Maybe he meant 25 years or something of that nature. I have no idea. But I'm going to have to just focus on these two because the numbers actually work out there, right? So sorry, I didn't read. This is the first time I'm reading this email. I'm trying to go through and keep it as authentic and real as possible as I would have a conversation with somebody. So what I'm seeing here is this 310,000 and 822. So what I want to do now is I want to hop right into an illustration. And so remember, it was 310,000 in 5% returns, if that's what he would have doing 2,000 a month. And then there's also 20 years was what was it? It was 822. Yep, 822. At the 20-year mark, you're looking at end year 20 right here is 822. Okay, so there's a couple things that come into play here. So first and foremost, in this policy, when we're looking at the numbers, there's a couple different options. This is obviously a company called Emeritus, and when we look at the numbers with this company, you're looking at the fact that he had some money in another company where that was it's going to be 1035 exchange over from an IUL potentially, and so there's a little more money going in year one simply because of that. But out of this money, you're looking at about 80%, right? Liquidity right there, about 85% or so liquidity. Now, what we're happening here is, although that's the case, you still get the death benefit right here, this 962. Now, going down to year 10, you can see that there's the 307. You've put in 276 total. You have the 307, but you also pick up the death benefit, okay? So when we look at that death benefit, that's an important thing. Now, one of the things I think he says, and I'm going to go back to it because I think it's important, is he says it right here, is I can easily build legacy funds for my kids this way. For the insurance part, I can get a $1.5 million term policy for my work, through my work, for less than $100 per month. All I'm worried about is the next 10 years for the death benefit. So all I'm worried about is the next 10 years for the death benefit. I'm gonna argue that significantly. 10 years from now, my house will be paid and my kids will both be gone, so I won't be leaving them in a bad spot. So this is the challenge with the buy term and invest the difference mindset and the philosophy, is that it's always looking at the bare minimum. It's always looking at the math, saying that there's a more efficient way on paper to get your money to get a better return. And this is not about a rate of return unless there's something that's not being said, because what he did say is that this goal is legacy. That is the plan of this policy, is to leave a maximized legacy for his kids, right? That is that is what we are looking at here as the objective of this, right? So when we see this and we say, all right, he can get that for $100 per month, I don't even care. I'm not even going to do the math and show like what would $100 per month look like if I were to add it to this, so on and so forth. That's not the issue. The issue is that this idea of like, when the kids are gone, I'm not leaving them in a bad spot. Therefore, they're going to be better off. What I'm interested in doing is saying, if your real interest is leaving a pure legacy, well, then it's not a matter of leaving them in a good or bad spot. It's a matter of taking that $2,000 per month, having an asset that's going to grow, that you can have liquidity, access, use, control of, and it's going to maximize what that legacy could be. That's one of the reasons I call it a self-completing plan, because it's beyond just the cash value inside of the policy. It's the fact that you have living benefits with it. If you have a Roth 401k, that'll be $800,000, and something happened, they would be the beneficiaries as well. But once again, now I don't want to combine that Roth 401k, because I'm not saying don't do that. I would say do the Roth 401k, have that $800,000, and if something happened to you, well, then guess what? They're going to have both, which is great. So all I really care about is comparing apples to apples and maximizing what the goal is of this $2,000 per month, which was stated as legacy. That's all I care about when I talk about this from a high level perspective. How do we do that? And at the same time, what benefits will it give you above and beyond that legacy while you're alive? And I'm going to get into that here, right? So I do understand that the above would be subject to taxes, right? So yeah, if that would be taxes. If they had these returns and this is a legacy, this is all going to be taxable to the kids. And so you got to reduce these numbers pretty significantly, right? And so all the numbers I'm going to be talking about are tax-free. So for instance, let's say they had to pay a 20% tax. Well, that 310 all of a sudden becomes, let's say 240, right? That's what that becomes. And this becomes, I don't know, like 700 or 680. I'm going to write 700 just for the sake of it. This becomes, let's just call it 20% less, whatever that is, 200, 300, let's call it 1.3 just for the sake of it. So like, this is important stuff to understand, is that there will be taxes taken out of this. Okay. And that's important to understand, right? So sorry, my computer keeps blowing up because I'm getting messages. So as we go deeper into this, right? Let me get to the end of this. Hopefully I'm missing something with the effectiveness of whole life insurance. Okay. So hopefully I'm missing something. Okay. So you are missing, right? You're missing the fact that, okay, you said you can borrow against it, still make dividends, use the borrowed funds to double down on another investment strategy, generating 10% or more combined potentially. Don't see how this could work though when you borrow at 5.5% interest and the dividends will be less. Okay, so it's not a matter of creating arbitrage or anything of that nature. What I will say is that there's a couple things here. A, yes, you're going to still earn dividends. Yes, you can still have access to the borrowed money and you can leverage that money. And the money that you're going to leverage is going to be generating, but that's based on what investments that you're going to do, based on what risks you're going to take and what assets you're going to invest in. So the things that I would say here is living benefits. So you have living benefits. and you have what's called a non-direct recognition. Okay, so as you look at these two things, these are the two components that I think are the most relevant to your situation, right? So when we look at the living benefits, what happens is if you become critically, chronically, or terminally ill, you're going to have access to this money on a tax-free basis while you're alive, right? So a portion of this money, a good portion of it, right? So you can use that for alternative medical treatments. You can use it for in-home care. You can use it for all these different things. And the beautiful part about that is what they do is they can give you that benefit, and it will still leave behind a benefit for your kids even after using that money. So it's just an extra form of leverage. So remember, we said here that at year 10, you got 310, but you really don't have 310. You really, the kids at the 5%, if they were to inherit it, because you're not going to use this for other stuff. And if you needed to, you could, but I mean, you're only a little bit behind on the access, but also you would be taxed on the gains of that. So you have to take consideration of that as well. So you have the inheritance issue from a legacy plan. Then you have the taxation issue on what you're going to actually earn, which, you know, you got to look at. You can't ignore that. And then you have the fact that you have living benefits, right? So let's just say they inherit it. I'm only going to be talking about this from an inheritance perspective. I'm going to compare the 260 to the 310 because that's what they would inherit it at, right? So that's something to take into consideration. And then on top of that, you have the death benefit of the 1.4 million here. That death benefit that comes into play, this 1.4 million, which is fantastic. And then on top of that, you have the fact that if you become critically, chronically, or terminally ill, you probably have access to at least a couple $100,000 to be able to leverage while you're alive. Now, if that happens, there's also going to be a death benefit left behind, but it's just flexible. And obviously, this gentleman is young. Hopefully, he's not going to have to use that living benefit feature by the time he's 53. But if he needs to, it's there. Now, the other component here is that you could see that we get down to 822. Remember, this is going to be taxed. This is going to be all taxed, and at 5% assumptions and growth. This is if this 822 would be if it grew tax free, but no CD is going to grow tax free. So you'd have to actually do the compounding out of that number minus taxes, and I bet you it's about in this range, in this $709,000 range, if that money is growing on a taxable basis, which it is. And so now we got $1.3 million in death benefits still, which is fantastic, because now, once again, there's just a leverage there. We have the living benefits access again, which is fantastic. And once again, this death benefit, if or compared the 822, and we take an inheritance tax off that, if for for example, something happens to this gentleman, you're looking at a $1.3 million legacy, not the 822. And so the important thing there is that this buy term and invested difference thing is like, okay, buy term and invested difference is fine. But once again, when you invest the difference, you're taking risk. When we're talking buying term and saving the difference, that's what I'm talking about, because this guy is saying he wants to put money into savings vehicles, not investment vehicles. He doesn't want the risk with this money. He wants it to be as guaranteed as possible. Nothing is going to guarantee the specific result of the legacy and provide these other benefits and protections like this, like the living benefits here, to be able to use if he wants alternative medical treatment while he's alive, if he needs it later in life, if he needs it for and wants it for something like long-term care or assisted living or something like that, he's going to be able to access his pool of money for that and still leave a legacy for his kids. You're not able to do that with these other assets. And once again, we can't compare, this 5% growing in this taxable vehicle to this. We got to run the numbers on that. And once again, I wasn't necessarily ready to do all that. I can run those numbers. I would encourage anybody to go run those numbers, but I guarantee the numbers work out in favor of the life insurance policy, because they always do. And when it comes to the buy term and invested difference, this is the one thing that I want to say that I feel really, really strongly about. And I want to go back and read it again. I can easily build legacy funds for my kids in this way. For the insurance part, I can get a $1.5 million term policy for my work for less than $100 a month. All I'm worried about is the next 10 years for the death benefit. So now, to me, that's speaking out of both sides of the mouth. That's saying, I really want to leave this legacy, But I really only care for the next 10 years because after that, they'll be okay. For me, I don't want to leave my family just okay. I want to create a system and create a heritage and create a fund and a pool where I can teach my kids how to leverage. And so it's not a matter of what's okay, what's not. It's a matter of efficiency. It's a matter of making sure that what I want to happen will happen when I want it to happen, whether I'm here to see it or not. The difference is if they do the term, well, all of a sudden the term insurance, A, you don't get the living benefits, and B, or maybe you could, if you bought a term policy with living benefits for the first, 10 or 15 years, you could do that. There's no doubt. But after that point in time, when the real risk on his life is higher at 62 and beyond, like the money here on the 5% investment fund, which by the way, this 5%, once again, if rates go down again, like they're trending at this moment in time, and I'm not even going to dare to project what they're going to look like over the next 15, 20, 30 years. I certainly know they're not going to be like bond funds were from 1980 to 2010. So I'm not going to project that. But like, to me, this is a pipe dream number where everything I'm looking at here is good because the dividend rates we're looking at are the lowest they've been in 90 years, right? So this is something that I can look at conservatively, or at least with some level of confidence, with a pretty high level of confidence. And to me, this is still a crapshoot, right? And there's still risk, and you don't have these other benefits. And so when I look at it through that lens, to me, it only makes sense that the whole life insurance is the way to go, because of the fact that now you have the fact that you have the liquidity in the short term, not completely liquid, but you get more leverage death benefit wise with his cash value than anything else. But then beyond, if the 10-year term when his kids, would be gone, expires and he doesn't use it, well, then now you're talking about $12,000 completely wasted, first of all, which, that $12,000 would have to be taken off of any savings or investments that he would do here if you want to compare apples to apples. So that 310 would actually be 298 if you wanted to compare a real cash flow example, 298 or a little less with interest. But you have to look at these things. These are the numbers that come into play. And so the cool part is now with whole life, because when the term ends, this is where the term insurance would end, right here, right? That's where it ends. And so when the term ends at that point in time, now from year 11 forward, this is all this column here of the whole life insurance, this death benefit would not be there. The living benefits would not be there. This is a completely tax-free legacy. Now, anything he has with his Roth 401k or any other assets that he wants to pass on as well, that would be in addition to this. And mind you, now when he's in retirement, he can leverage this as a volatility buffer, as a bond fund that has lower volatility, and it's a volatility buffer for his retirement assets. And when he gets to the end of his life, if he wants to use it for, gets near, if he wants to use it for long-term care, he can. And as he goes through, and if he lives a long, happy, healthy, fruitful life, now he's got all these assets that he's going to pass on a tax-free basis. Sure, he could get to higher nominal values, but it's really the tax-free after everything that happens that matters the most. And the other assets he'd be growing in a taxable fashion. Of course, now we have to take into consideration what are rates going to be, what are tax rates going to be, what are interest rates going to be, what are the actual returns inside of CDs, bonds, and everything going to be. There's so many variables outside of our control, outside of our even ability to predict, in my opinion. And one of the things that I just love and I feel to be so true about this is that when I look at whole life insurance, and when I look at saving with a whole life policy and putting my safe, liquid, accessible money in a whole life policy, why am I doing it? I'm doing it for these reasons, because I'm having that insurance company manage that risk. And historically speaking, Tom Wall did this example showing that whole life insurance companies over the last 80 years have produced every 30-year period, have outperformed bonds, period. And so we're not doing this for this 5-year window of time that we're looking at right now. We're doing this, I'm assuming, if the legacy is really the option in the play, we're doing this from a perspective that needs to work from a long-term perspective, and that will solve multiple problems that, quite frankly, somebody who's 43 years old right now doesn't have these challenges yet. But at some point in time, they're going to, and they're going to have to deal with them. And so this policy will grow with them. It will have the emergency fund and the opportunity funds and all these things for real estate right now. It builds the legacy fund. You can use the cash to let your kids have opportunity as they get older. Maybe this turns into a grandkids college fund. Maybe it turns into something else. But the bottom line is you have complete control. The tax-free nature takes off the taxation risk and that volatility risk in that way, because we don't know what's going to happen in the future. And so that's pretty powerful. And aside from that, I would say, this is, to me, I would say that this is just the most powerful thing. The last thing that I will say on this is that this is an emeritus example, right? So when I look at the long-term growth, the reason that emeritus is so strong is because their guarantees are strong. They have a 3 3/4 guarantee on this. When we look at this is assuming a dividend is paid every year. Once again, dividends in whole life insurance are assuming two things: that first, that a dividend is getting paid, and secondly, that the dividend is paid at this year's current dividend rate. So this column here is assuming that they're paying a dividend just like they have for 100 plus years, consecutively without missing a year. So I think we can bank on that. If we can't bank on that, I think we're in trouble. And secondly, it's assuming that it's at today's current rates, which is the lowest rates in nearly 90 years, right? So that's taken into consideration. The other element here is because of Section 7702, the way that emeritus works is that with the higher guarantees, they actually have lower performance on the dividend side. Because when we look at the dividend, if you see the annual dividend, remember that seems pretty low, but the dividend is really just the dividend above the guarantee. Okay, it's not the dividend and the guarantee combined, it's above the guarantee. What is that dividend? And so you got to look at the guarantee, and then the dividend is above and beyond that guarantee. Okay, that's important to understand. Now, being that they have a really high guarantee, that's their current assumption, their non-guaranteed current assumption here is lower than other companies. What I want to do to just kind of land the plane here, and this is not an apples to apples thing, because the way that I designed this, they actually stopped funding it a little earlier, the way that it's funded. But I wanted to look at a different company, and you can see it's a smaller death benefit out of the gate. That's the way I designed it, just to kind of show how we can do this with options. Once again, we didn't have this low of a death benefit because the legacy play meant something. So there was a leverageable kind of component here. You can see that there's a little higher percentage of cash value, a little less death benefit, but the $3,000 in less cash value liquidity on the other policy with emeritus provided $400,000 more death benefit, almost, or $300,000 more in death benefit, right? So when we look at that, that is what it is. You could see that the cash value here is 324 instead of 307 or 308. And at year 20, the cash value is just going, it's getting better and better. Actually, the cash value, I think, at year 20 is better with emeritus, if I'm looking at this properly. Year 20, yeah, the cash value is better with emeritus there, and you got the better death benefit. So when I look at this, if short-term liquidity is important, well, then Lafayette wins. But long-term in this example, and it's not going to be the same for every policy and every person at every age. This is a person who is super preferred, very healthy. And so in this situation, emeritus just wins. And you look at the death benefit, you look at the growth, the liquidity, all the benefits that I've said to this point in time. And I think, what we see is this seems like a no-brainer to me. When you compare this to a CD, to bonds, to savings accounts, high yield savings accounts, money market accounts, anything of this nature, whole life will beat it, because the other accounts, they may spreadsheet out at a better rate, let's say a 5% return. But then when you take taxes out of the equation, my mindset is you can either trade paying taxes, or you can and get to about the same money in whole life, or you can and you could pay taxes and have about the same money as whole life at the end of it, or you can have what you would have after taxes in the other one and get living benefits and get the life insurance leverage and have the ability to borrow against it and leverage it for real estate investments and other things, which is what we talk about when it comes to cash flow hacking. So if you want to go deeper into that, because I don't want this video to go super, super long, I would encourage you just do a Google search for hashtag cash flow hacking, and or a YouTube search, and you will find those videos. I'll put a link down below that will kind of go deeper into that if you want to continue the educational journey. If this happens to be one of your first videos that you've watched, go from there. So hopefully you found value in this. If you did, please like, share, get this video out there to people. It's important. And that's it. So till next time, if you have any questions, comment in the comment section below. I'll do my best to engage with every comment. Have a blessed, inspirational day. We'll talk soon. See ya.